If you are just looking for some sort of rule of thumb, below 579 is considered poor. Between 580 to 669 is generally considered fair. 670 to 739 is considered good. 740 to 799, that's considered very good. And if you're above 800 or above, that's considered excellent. I have looked at my own teenage and young adult kids and thought, if I wanted to teach them what I have learned about wealth building and what pitfalls to avoid, what would I teach them? Where would I start? What would I want them to know? The topic of credit is clearly one of those foundational wealth building topics. We start off our consumer lives not even knowing that a credit file has been opened on us and it is being used against us. You did not ask for it. It happens automatically. Then, years later in life, when the car dealer wants to charge you astronomical rates on a car loan, or when you want to buy a home, or when you are turned down to rent an apartment or denied employment, you slowly start learning how a lifetime of buying decisions is having a huge impact on your life. A profile of all your borrowing and credit card charging is getting tracked, and a judgment is being made about how you handle money and your credit worthiness. It is like you have been tracked and studied for years like a lab rat. I call it the credit game. And like any game, before you can win at it, you must understand it. You must understand the rules of the game. To build wealth, you must understand how your usage of credit, your accumulation of debt, and your purchasing decisions affect your financial life. What I have included in this presentation is what I would have wanted my younger self to know. This is what I want my kids to know. This is what I want you to know, and anyone who has the interest of building wealth and becoming financially free. Did you know that 70% of people have at least one credit card? 70%. And 14% of Americans have at least 10 credit cards. 14%. I used to be one of those people. Around half of Americans carry credit card debt, meaning they don't pay off the bill every month. If you know anything about the credit game, you know that is a no-no. We will talk about that more later. I also find it interesting that statistics show that when you make a purchase with a credit card, you are likely to spend more money than if you purchased it with cash. In fact, studies show that consumers will spend up to 83% more money when using a credit card versus using cash. So I'm not trying to recommend going back to all cash society. We're well beyond that. We're into digital currencies and everything. It's just interesting to understand the psychology when you're using a credit card or digital money to make purchases, because there's no friction there. When we used to use cash, there was friction. You could feel that money leaving you. Now you just hand a credit card, you get what you want, they give the credit card back to you. You feel like you didn't lose anything. In summary, credit is ubiquitous. We all use it. We all have it. It has an impact on just about everyone's life. The trillions of dollars of debt that we have accumulated is crushing our ability to build wealth. It is crushing our ability to send our kids to college, reach financial freedom, start that new business, retire early, or to simply do what we want to do. It is crushing our ability to have a peaceful financial life, to give and support our charitable causes, to pursue our dreams. Yes, we have a ferocious appetite for credit and debt accumulation. But do you know the impact it has on your financial life and your ability to build wealth? What I have discovered is most people simply do not know how credit works. They do not understand debt. They have no idea about credit utilization and how it impacts their credit worthiness. Most people simply do not understand how amassing consumer debt to purchase electronic devices, furniture, and new cars is affecting their financial life and postponing their journey to financial freedom. Let's start off by consider some of the myths out there about credit and how I feel this basic knowledge is sorely needed. There was a 2014 survey from the NFCC and a different survey by the American Bankers Association that showed about half of adults mistakenly believe that credit scores are listed on their credit report and that the two are the same thing. Credit score and credit report, two different things. We'll talk about that more later, but the credit score is a reflection of what's in your credit report. Another myth is that people believe their age factors into their score. There was another survey from CFA. These are not statistics I'm making up. A survey from CFA and Vantage Score that found that 38% of women believe their age determined their score, and 48% of men held the same view. And then you have marital status itself. If you believe getting married can help your score, think again. About 34% of women and 46% of men think that marital status influences your score. Again, this is a myth, not true. The goal of this Credit 101 training is to help demystify this topic of credit usage and how it affects your financial profile. I aim to break down this credit topic in simple, basic terms for the average person to understand. My goal here is to present this in a manner such that a high school student can understand it, and if needed, so that you can take any corrective actions if warranted to fix your credit. I am all about building wealth, not building a great credit score. Building wealth and building a great credit score is two different things. There is a difference. But to build wealth, you need to understand how the credit game works, or it will hinder your ability to accumulate assets and create wealth and become financially independent and free. One last thing. For this training, I am not encouraging, discouraging, or suggesting how to use your credit or if you should use it at all. This is purely about how credit works. Now, I have very strong opinions about credit and using debt, if it should be used and what it should be used for. Like everyone else in the public square, yes, I have strong opinions too. I am sure I will be sharing those opinions in future posts. And when I do, remember that my opinions will always be informed by the data, aka the facts, as well as my firsthand experiences on how you build wealth. This training is not about how to strategically use credit. I am not going to present an argument about should you carry credit card balances or not, or the pros and cons of chasing credit card points. My opinions simply do not matter. The fact is, you are being graded on your buying history and how you use debt. And that grade is likely having a huge impact on your ability to pay your bills, buy a home, the cost of college, and most of all, your ability to build wealth. Your credit history determines your monthly budget and how much money you have left over each month, or how much you are in the red each month. It is determining what you can and cannot afford. How much you pay in insurance is affected by your credit history. Will you be approved for an apartment? Employers are looking at it to make employment decisions about you. This presentation is just the facts about how credit works and what your credit report tells lenders. However you decide to use your credit, it is obviously and totally up to you. My passion is wealth building. I just want to make sure you know how your credit usage affects your overall financial life and your ability to build wealth. My hope is, as you begin to understand how your purchasing decisions affect your ability to build wealth, you will begin making different buying decisions on your journey to financial independence. For the most part, this stuff is not taught in schools. You have to learn this on your own. So let's get started. Let me set the table. Because you may often hear these words used interchangeably when it comes to the topic of credit and debt, let's start with a few definitions. Credit. Credit is just your ability to receive something of value that you do not pay for in full today. In other words, you, as a borrower, may agree contractually to receive the full value of something today with the understanding that you will pay back the value of what you borrowed over time at a specified interest rate. Interest or interest rate. The interest can be viewed as the cost that the lender charges you to extend you the credit. Let's take an example. Take a $40,000 new car purchase. You may have credit extended to you in the form of a $40,000 car loan from a finance company or bank. You did not pay the car dealer $40,000 today. The finance company did. However, with the finance loan, you get the full use of the car today because the finance company paid the dealer in full for the new car. All the finance company asks is that you pay the finance company back, say, $749 a month over, say, a 5-year period. This $749 includes the price of the car plus interest. Remember, interest is the cost of the credit. That's the profit that the bank or finance company is making. You pay that $749 back every month, and that's the cost of granting you the credit. So instead of you giving the dealer, the car dealer, $40,000 today for the cost of the car, you pay the finance company $45,000 over 5 years. $40,000 for the cost of the car plus $5,000 in interest charges for the privilege of borrowing the $40,000 in the form of a $749 payment that we mentioned before. Debt. Let's talk about debt. What is debt? Debt is something that is owed to someone else. In the car example, the lender advanced the car dealer $40,000 on your behalf. As a result, you are contractually obligated to repay the lender the $40,000 with interest. Debt shows up in our consumer life in the form of mortgage loans, car loans, credit card balances, just to name a few. Of course, you can have personal debt if you borrow money from friends or family that you're obligated to pay them back. Credit report. Your credit report, also known as your credit file, is a report of your credit history. It is a collection of data about your borrowing and repayment activity. Your credit report contains information that your creditors and lenders report about you to the credit bureaus. Like your credit cards, car loans, student loans, mortgage loans, the date these accounts were open, what the balances are you paying consistently? This is what you will find in your credit file. Your credit report contains information on how much you owe. Are you paying your bills on time? How long you have had accounts open? Any judgments or bankruptcies in your name? And of course, your credit file contains information that identifies you, like your name, social security number, address, phone number. The file will also contain any other previous names, addresses, and phone numbers. This is all used to identify you, of course. It can even show your current or former employers. Credit bureau. What is a credit bureau? Credit bureaus are agencies that collects the information in your credit file, and they sell this information to creditors. You may have heard the names Experian, TransUnion, Equifax. Those are the 3 biggest credit bureaus. Credit bureaus are basically data analytics companies. They are holding all the data about your financial life. Why do creditors need it? Because creditors work with credit bureaus to get this information about your financial life. Creditors need this information when lenders need to decide on whether you should be granted a loan, if they want to give you a credit card, and what your available credit limit should be if they give you the credit card, and what interest rate they should charge you. Remember, interest is the cost of credit. So the better your credit score, the less you will have to pay in interest. Creditors rely on the credit bureaus and the information the bureaus hold about you in your consumer credit file to help them make these decisions. The type of creditors out there who rely on the credit bureaus for this information are institutions like banks, mortgage lenders, credit card issuers, and other personal financial lending companies. Credit bureaus, this is an important distinction about credit bureaus and credit lenders or creditors. I'm using credit lenders and creditors interchangeably. Remember, credit lenders are banks and mortgage companies. The difference between credit bureaus and creditors, credit bureaus do not determine if you will be extended credit by one of these creditors. They do not determine that. All credit bureaus do is collect the information about your borrowing and repayment activities, and they report this information to the creditors. Credit bureaus also use this information to calculate a credit score based on the information in your credit file. Okay. The three largest credit bureaus, again, are Equifax, Experian, and TransUnion. So finally, let's talk about your credit score. So remember, your credit file holds your financial lending activity, your repayment activity, all your financial behavior is held in the credit file. Your credit score is then uses your credit file to calculate a score for you. In its simplest form, a credit score is simply a 3-digit number that reflects the likelihood that you, as a consumer, will repay your debts. It is used to tabulate your credit worthiness or how risky you are to lenders. Credit bureaus calculate this number by applying a scoring methodology to the information in your credit file. Creditors can then use your score to determine your credit worthiness and your likelihood you will pay back debt. Lenders want to be sure if they loan you money that they will get their money back. Credit scores provide a direct correlation between risk and score. The better or higher the credit score, statistics show that you are more likely to pay your debt back and pay it on time. Most people have heard of FICO. FICO is just one methodology used by the credit bureaus to compute a credit score. There are other scoring formulas used out there by creditors like Vantage Score and Community Empower, CE. And each scoring system has different versions of its own. FICO itself has over 50 different versions of your credit score. You know, when you hear the term FICO the most, we use it almost as a euphemism for your score, your credit report, your credit worthiness. But remember, it's just one of the many scoring methodologies out there that generates a number for you that reflects your credit score. All you need to know about the use of these different scoring systems is that a bank could get one credit score for you for a new car loan, while at the same time, a mortgage company could run your credit and get a slightly different credit score for you for a home loan. That's because they're using different scoring models. For the sake of this discussion, we will focus on FICO, as FICO is the most common scoring method used in the United States. Besides, they all work relatively the same. You really don't need to know the differences. The things that you can do to improve your FICO score or one type of your FICO score, the same activity will improve all their scoring models. Likewise, the things you do to degrade your score will degrade it across all scoring models. They all work relatively the same. All you need to know is what is the type of consumer activity that makes your score go up and what type of activity makes your score go down. Those factors of how your score is calculated is generally the same amongst all these formulas with slight differences. So I would not worry about what lender is using what scoring model for what purpose. In this instance, it is okay to just think FICO score as a euphemism for your credit score. Credit scoring models are essentially reading the history in your credit file. And by reading that history, the scoring model will produce a number that represents your individual credit score. Be aware that your credit score can and does change all the time. This is because the information in your credit file is changing all the time. Think of it like being a student in a math class. You are graded based on different factors in the class, such as quizzes, class participation, the tests you take, how well you're doing on homework. Each category carries a different weight. For example, your homework grade is probably about only 20% of your overall grade. Class participation could make up 10% of your grade. Maybe chapter tests are worth a whopping 50% of your overall grade. Your credit score works much the same way. Different criteria have different weighting. And just like a math class, at any time you could go to your teacher and ask, what is my grade based on and how have I performed? You may have a grade of 70% today, but next week your grade could be 90%. Think of your credit score much the same way. It's just a score that reflects a snapshot in time. It can improve or degrade based on your consumer activity. As I stated, your credit score is used by lenders to determine credit risk. The riskier you are, the higher interest rates you pay on loans. If you are too risky, the creditor may not grant you the loan at all. The less risky you are, as determined by your credit score, the more credit you may be granted and the less interest you pay on your loans. When it comes to credit, your FICO score, aka your credit score, is like your class grade. Factors that determine your score. Payment history. Payment history makes up 35 or can make up to 35% of your score. Now, always remember there could be slight variances between the scoring models, but roughly 1/3 or 35% of your score is made up by payment history. Do you pay your bills and do you pay them on time? It is that simple. That's what we mean by payment history. Payment history is the most important factor in your FICO score. Research shows that payment history is the strongest predictor as to whether you will default on your payment agreements like loans and credit cards, or if you will pay your debts on time as agreed. And as you can imagine, a lender's number one priority is your past record of paying back your loans. Before I educated myself, I used to think that simply paying your bills on time was 90% of your score. It is not 90% of your score, but it is 35% of your score. 35% amounts to the largest share of your FICO score. The first thing lenders want to know before issuing you credit or renting you an apartment is whether you have paid past credit accounts on time without default. This is the first thing they want to know. This helps a lender figure out the amount of risk it will take on when extending credit to you. Always be sure to keep your accounts in good standing by simply paying your bills and paying them on time. It is a no-brainer. You owe the money, just pay your bills when due, at least the minimum amount due on or before the due date. This is critical. Creditors can report your late payments to the credit bureaus, Experian, Equifax, and TransUnion. They can report it once you're 30 days behind, and the late payment can remain on your credit reports for up to 7 years. So that's a long time to affect your credit history, 7 years. You might ask, how long does it take to improve your payment history? The answer is 1 to 3 months. So if you have some late payments and now you're paying regularly again, it begins to improve in 1 to 3 months. I'd say a month or two after the creditor reports that your balances have been paid off, your scores will increase significantly. If your account is in collections, you should see improvement in your score within 1 to 3 months after it has been paid off. We'll talk about that more later, the timetables and what you can expect. But, again, just the importance of credit. Here's a little fact as to how your credit can impact your life. TransUnion did a survey. In their survey, 48% of landlords said results of a credit check is a top cause of lease rejection. And I can vouch for that. As a landlord, I know I look at it as an important factor in my decision. Another factor that goes into your overall score is the amounts owed. This can be around 30%. This is the total debt. When we're talking about amounts owed, the total debt you owe on all your credit cards, on all your loans. This is the next largest factor in determining your overall credit score. In general, the amounts owed factor refers to how much debt you carry in total. If you think about it, it makes sense. The amount you owe to other creditors and lenders can impact your ability to pay back your creditors on a monthly basis if the amount you owe becomes excessive. So as your balances increase, the probability of default increase. This is just sheer probability and statistics. Now, having debt does not necessarily mean you are a high-risk borrower. However, if you are using a lot of your available credit, this may indicate that you are overextended, and banks can interpret this to mean that you are at a higher risk of defaulting. Scoring systems like FICO, they look at 5 different factors when it comes to the amount owed part of the pie. Your FICO score considers 1, the total amount you owe on all accounts. 2, the amount you owe on different types of accounts. 3, the total number of accounts that you have with balances. 4, your credit utilization. And 5, the amounts remaining on installment loans. Let's talk about each of these briefly. The amount you owe on all accounts. Note that even if you pay off your credit cards in full each month, your credit report may show a balance as those on those cards. The total balance on your last statement is generally the amount that will show in your credit report. So it could take a month for that payment, what you've paid off, to then be reflected in your credit report and show up in your score. The second part was the amount you owe on different types of account. The credit bureau will analyze the amounts that you owe on specific types of account. For example, how much do you owe on credit cards, installment loans, if you have judgments? So the types of accounts is factored in the amount you owe. The total number of accounts that you have with balances. The amount you owe is also broken down into that subcategory. If you have many accounts that have balances on them, that can indicate that you are at a higher risk to a lender. For example, if you have 5 credit cards and you carry a balance on each one of them month after month, that person is riskier to lenders than someone with 5 credit cards, but you may only carry a balance on one of the cards month after month. Then you have credit utilization. Credit utilization, I really want you to learn and understand this one. This has a big impact, and this is one where it's very, very easy to improve your score if you learn how to adjust your credit utilization. So what is credit utilization? Credit utilization is especially important in the total debt picture, and it is computed on your revolving credit lines. What I mean by revolving credit is essentially credit cards or home equity loans. Any account that you can pay down, but the account remains open and allows you to continue making new charges against the account up to the account limit, that's a revolving account. Contrast that with like a car loan, which is an installment loan. You pay down a car loan, you can't put new charges on there. All you can do is pay it down. Once you pay it down, it's automatically closed. Credit cards, which is a revolving account, it stays open. You can run up charges, pay it down, run it back up, pay it down. It just stays open. So the utilization rate reflects the percentage of credit you have available to use on your credit card account. Basically, if you have a lot of credit at your disposal that you can use, this is what utilization is looking at. If you have a lot of credit at your disposal that you can use, but you are not using it, that is viewed favorably. Low utilization rate shows lenders that you have self-control. Simply because you have $20,000 at your disposal that you can use, doesn't mean that you are going to use it all. I would trust that person more with new credit. In contrast, using a high percentage of the credit that you have available to you, say you have a $10,000 credit card balance and you've used $9,000 of it, this means you are close to maxing out your credit cards. This can have a negative impact on your FICO scores. You are higher risk to lenders in situations like that. Utilization rates are determined by aggregating all of your revolving credit card accounts to compute the rate. So again, it will add up the available credit on all your revolving credit, all your credit cards, lines of credit, and use an aggregate score to determine your utilization rate. Let's take an example. Assume you have four credit cards, each with a $1,000 balance limit. Card A, you never use. Card B, you never use. Card C, you carry a balance of, say, $500, and card D, you carry a balance of $500. So you have balances on two of the four cards. Your utilization rate would be computed this way. The rate would be computed to be 25%. That's computed by $1,000 total, which is the total balance you are carrying on all four cards. Two cards, $500 a piece. That totals $1,000. So out of the four cards, you're only carrying a balance that totals up to $1,000. And then you divide that by how much credit you have available on all four cards, which is $4,000. That's the total available creditable on all four. So 1,000 divided by 4,000 is 25%. Your credit utilization rate would be 25%. Experts advise keeping your usage below 30% of your limit. Many people say lower. I say lower. Generally, I definitely wouldn't go above 30%. Both on individual cards and across all your cards. Keep that below 30% or as low as you can. Again, I would aim for 10% or lower. The lower, the better. My advice, if you use credit cards, seek to pay your balance in full every month. That will ensure you have a favorable utilization rate. You just pay off your accounts every month. Final factor here in the amount you owe is the amounts remaining on installment loans. When it comes to installment loans like car loans and student loans and the like, the amount owed versus the original amount borrowed impacts your score when it comes to the amount owed portion of your score. So you will notice it too, particularly if you use credit tracking services where you get your credit report. There's many of them out there. But if you have installment loans, car loans, student loans, as you pay them down, they will often notify you, oh, you have paid off 20% of your car loan. You've now paid off 40%. The reason why you get those kudos is because that's improving your score. And that's all I'm saying here. As you pay those down, obviously that will improve your score. Paying down installment loans is a good sign that you are able and willing to manage and repay debt. It's just common sense. In summary, the amount you owe in debt payments is a substantial part of your credit score. Your score will improve as you pay down balances. The next factor I want to talk about when it comes to the factors that make up your credit score is the length of your credit history. In FICO, that's generally 15%. When it comes to credit scores, the longer your credit history, the better. For example, FICO considers the following when looking at the length of your credit history. How long your credit accounts have been established, including the age of your oldest account and the age of your newest account and the average age of all your accounts. It also considers how long it has been since you have used certain accounts. A longer credit history always has a positive effect on your credit score. Here are a couple of tips if you are having difficulty establishing credit and getting your credit history going. Tip number one, I would say if you have problems establishing credit on your own, What some people do is apply for a secure credit card. A secure card is a card where you provide cash collateral for the line of credit. FICO looks at secure cards the same as any credit card. Most banks and lending institutions offer secure cards, but not all of them. If you go this route to establish credit, just make sure the bank reports the secure card activity to the credit bureaus. Again, I am not recommending you do this to establish credit because I could give you many reasons why you should not do this as well. There's pros and cons to this. But I know a lot of people want to establish credit and get a credit history going. This is just one way that people do it. I will be giving my opinion and ad nauseum about credit and FICO scores and chasing credit scores and all of that stuff later. I am just letting you know that if you are trying to fix your credit or you are trying to get a high FICO score and you feel compelled to establish credit this way, this is one option that people use who have had trouble establishing credit the conventional way. Here's another tip to establish credit and get your credit line going, get a credit history going. Another option that many people use to establish credit if they do not have it is that they, if they can, get a friend or family member with good credit to be a co-applicant with them, or to have the friend or family member add them to their existing credit card account. This can also help you establish your own personal credit history. Depending on your relationship, this may be a lot to ask a family member. But again, my point is to let you know that there are alternative approaches to everything. If your friend or family member is willing to authorize you on their card, it is a good way and an easy way to start growing your credit history if you're having problems establishing credit yourself. My wife once did this for me because for many years I operated with no credit cards, and she was just worried about me when I traveled that I would need the convenience of a credit card. I did not have to apply or fill out an application or anything like that. She just requested it from her bank, and I just received the credit card in my name at my wife's request. Now, mind you, the existing $7,000 balance that my wife had on the card at the time that she'd accumulated now showed up on my credit report as well as hers as money that we both owe. Although I had not charged a penny of it, how the account was paid and if it got paid on time was reported on both of our accounts. So you must be careful if you do this stuff and understand the risk and the impact. Again, my personal advice to the average person is to be leery of doing this. It is fraught with risk. I only raise these options here to let you know that there are different ways to begin establishing credit if you are having problems of qualifying on your own. Should you close paid off accounts and cut up the card? This is often a question that's debated back and forth. As you learn more and more about the credit game, you will often hear people say you should never close a credit card account. You can pay it off, but never close it. People say this because the theory is, although you feel you are doing a good thing by paying off the card, closing the card and cutting up the card, you are actually hurting your credit score. They say that even if you plan to never use the credit card again, just take it out of your pocketbook, lock it away, and never use it again. But do not close it. That can hurt your credit score. Again, in an effort to stay focused on the basics of this training, I will not weigh the pros and cons of such a decision. All I will point out here is to highlight that this school of thought comes from factors such as credit utilization and amounts owed and length of credit history, the topics that we already discussed. There may be good reasons to close an account and cut up the card, as they say. But now that you are more educated about how your score is tabulated, it is easy to see how closing a credit card account can indeed increase your utilization rate, and it can reduce the length of your credit history. By definition, closing an account will lower your overall credit score, at least in the short term. If you are tempted to shut down that credit card that you just paid off and close the account, consider the impact it will have on your score if your mission is to get the highest FICO score you can get. The behavior of limiting credit usage may outweigh the temporary benefit of a higher credit score. You have to make that call, that decision. The final factor in your score is credit mix. That's a 10%, again, generally 10%. I think FICO has it as 10%, a 10% factor that goes into your score. So what is credit mix? Credit mix is the different types of credit accounts you have on your report. In general, the greater variety of account types you have, the higher your score may be. Creditors view credit mix favorably because they want to see how well you manage different types of credit. Credit mix is a factor in your overall score, but I would not run around trying to establish different types of credit lines in an effort to maximize my credit score. Having said that, let us review a couple more common credit types to make sure you know the difference. We talked a little bit about revolving accounts earlier. Revolving accounts are those credit accounts that gets renewed as the debt gets paid. It is considered revolving because unless you close it, the account is never closed. It remains open, and the balance will fluctuate up and down based on your usage activity. But you only make a payment if you have a balance, and you can only charge on the account if you have available credit to use. The most common type of revolving account is a credit card. As long as you have not hit your credit limit, you can keep charging and using the account to make purchases. The payment fluctuates each month based on your outstanding balance. You are only charged interest on the outstanding balance you have remaining on your account. If you pay the balance in full each month, no interest is charged. Home equity lines of credit, aka HELOCs, that's also a common type of revolving account. Very similar to credit cards. But unlike most credit cards, HELOCs are generally secured by real estate. Some examples of revolving credit are credit cards, as we say, retail store cards, gas station cards, HELOCs. Remember, your utilization rate that we discussed earlier is computed based on your revolving lines of credit. Let's talk about installments account. This is another type of account. Installment accounts usually require a fixed payment each month until the balance is paid down in full. Once the loan is issued and you begin to pay it down, you cannot make new consumer purchases on the account like you can with a credit card. You can only continue to pay the balance down to zero, which when that happens, the account is automatically closed. The full amount of the loan is issued up front and put into use at the start of the loan. The initial terms, like the monthly payment, interest rate, the due date, are also fixed and determined at the start of the loan. Some examples of installment accounts are mortgage loans, auto loans, student loans. You also have credit inquiries, a new credit that makes up 10% of your score. Let's talk about this for a second. Credit inquiries occur when lenders, or anyone really, request your credit report on your credit score. Inquiries make up 10% of your FICO score. Credit inquiries typically occur when you request new credit. In other words, you apply for a credit card or apply for a bank loan, say. In general, to creditors, if you are applying for a lot of new credit, especially in a short period of time, you can be viewed as a riskier credit risk, particularly if your credit history is not that long. When it comes to the topic of credit inquiries, there are two types you should know about: hard and soft. Hard inquiries and soft inquiries. Hard inquiries are the bad inquiries that have a negative effect on your credit score. But you really can't get around them if you're applying for new credit. Hard inquiries are when you explicitly give a creditor, a bank, a finance company, a credit card company, a mortgage company, you explicitly give them the right to check your credit report or your credit score. Like if you're filling out an application for new credit or for a mortgage, you generally have to grant them the right to check your score. That's going to generate a hard inquiry. Hard inquiries occur when you are applying for new credit, making a loan application, or if you are applying for some credit or a loan type where you have filled out an application or you have given the requester the right to check your credit as terms of approving your application. These are the credit inquiries that makes up the 10% of your credit score. Soft inquiries, on the other hand, are completely ignored. Soft inquiries typically occur when someone checks your credit score unsolicited, meaning you didn't ask them to check it. They just checked it without your knowledge or without your permission. For instance, this is done sometimes because creditors send you an unsolicited credit card offer. Soft inquiries also occur when you check your own credit report. They can occur when an employer or a utility company checks your score as well. Generally, if no credit decision is being made when someone checks your score, that is considered a soft inquiry to the credit bureaus and will not impact your score. Always remember, checking your own credit directly through the credit bureaus or through other authorized credit services never affects your credit score. You can do that at any time. A few things to remember about inquiries into your credit file. Credit inquiries have a small impact on your credit score, only 10% of your total score. And remember, these are only the hard inquiries. One hard inquiry could decrease your score by around 5 points or less. It's not much. The longer your credit history, the less the impact. Also, when you apply for new credit, a new credit card, a new bank loan, that inquiry will remain on your credit report for 2 years. That's a hard inquiry. It will remain on your report, or can remain on your report up to 2 years. The effects of credit inquiries on your credit score can be a mixed bag. For example, when you open new accounts, it can lower your average account age, which can have a negative effect on your credit score. You will notice the impact of this more if your credit history is not that long. On the other hand, if you only have, say, revolving lines of credit, like credit cards, then you open an installment loan account with a lender, this could improve your credit mix. As previously discussed, credit mix is viewed favorably when it comes to computing your credit score. Also, obtaining new credit will increase the amount owed, which can lower your score. While at the same time, if the new credit you open is a revolving credit line, this can lower your utilization rate, and a lower utilization rate can improve your score. So, as I say, new credit inquiries can be somewhat of a mixed bag. I need to talk about rate shopping here. Rate shopping is when you are checking with several lenders for new credit to see who will offer you the best rate. But this new credit you are shopping for is all for one purpose, like buying a new car. Under normal circumstances, your credit score would be shaved a little bit each time you made a new application for credit, because that generates a hard inquiry. For example, let's assume that you are preparing to buy a new car and you are making a car loan application at several different financial institutions to see what rate they will offer you. What rate shopping does is it allows you to shop around for the best rate without dinging your credit score for each credit check required when you fill out multiple credit applications with the different lenders. Rather, the credit scoring formulas used by the credit bureaus generally will take into consideration that all of these credit inquiries that are occurring in a short period of time are all related to one purchase or one line of credit you are seeking. In other words, they assume you are buying one car, not multiple cars. As a result, your credit score will only be dinged once for all the inquiries. There's nothing you need to do to trigger or notify the credit bureaus you are rate shopping per se. The scoring formulas used by the credit bureaus are designed to automatically take rate shopping into consideration. The result is your credit report will not get dinged by every new car loan application as long as it fits the criteria for rate shopping. All the credit checks will be grouped together and counted as one. Rate shopping generally applies to mortgage loans, car loans, and student loans. Rate shopping does not apply to new credit card applications. Based on the credit bureau, the window for rate shopping can be anywhere from between 15 to 45 days. As long as you are doing your rate shopping for the same type of loan within this time frame, within this window, credit bureaus will view this as rate shopping, and they will not decrease your score for each new credit check done against your credit file. Bankruptcy. There is no way I can cover a topic like credit and credit scores without addressing bankruptcy and the impact it has on your credit. First, let me point out the good and the bad. Firstly, the bad. Yes, bankruptcy has a huge impact on your credit score and your ability to purchase things on credit. I'm sure this does not come as a surprise to anyone. There is no doubt about it. Some studies have shown that filing bankruptcy could negatively impact your score anywhere from 130 to 200 points or more. A point swing like that can take you from having very good credit to very bad credit in one fell swoop. And most creditors will not lend to you or grant you new credit for a certain amount of time after you have filed bankruptcy. That is the bad, okay? Now, the good, or I should say the not so bad. Bankruptcy is not what it used to be. The laws are there for a reason. They are there to help you recover and to get back on your feet. The wealthy and business owners use the bankruptcy laws all the time to their advantage. Personal bankruptcy used to be a financial death sentence, where today, not so much anymore. It is much easier to recover from a bankruptcy today than it used to be. And in my opinion, bankruptcies carry nowhere near the stigma that it used to. Yes, you take a big hit on your credit score. But I am sorry, if you have hit the point where you are filing bankruptcy, meaning you are financially insolvent, you cannot pay your bills, being concerned about a good credit score at this stage of your life is the least of your problems. And if you are at this stage, your score is likely very low to start, and it can only fall so much lower after you file bankruptcy. One should be thankful that we have bankruptcy laws that allow people to start over. Without them, it is back to debtor's prison. Yes, indeed. If you file bankruptcy, it will take some time to reestablish credit, but it is not permanent. Let us look at two examples of buying a car and buying a house after a bankruptcy. I will use these two purchases as an example because they are two of the biggest purchases people will make using their credit. A car is almost essential to function in society. In some places, it is nearly a must. And of course, a home is something we save for and work much of our lives for. Owning a home can be the key to wealth building. That is an important purchase. So let us look at how bankruptcy affects these two major purchases. Example 1, getting a car loan. Now, firstly, when you file for bankruptcy, many bankruptcy trustees will exempt your car if you already have one from the bankruptcy because they have realized exactly what I just said. A car is almost essential to getting around and to earning an income in today's society. You need it to get back on your feet. But if you need to purchase a new car, this is what you can expect. With a Chapter 7 bankruptcy, lenders generally like to see your bankruptcy discharged before they will offer you a new car loan. With Chapter 13, lenders may require permission from the court to grant you a new car loan if you have not completed your repayment plan. Let's talk about example 2, getting a mortgage loan. Let us look at buying a house. With a Chapter 7 bankruptcy, typically, you must wait until the bankruptcy is discharged. For a conventional loan, the wait is generally 4 years before you can make a new loan.
The wait is typically 3 years for government-backed USDA loans. For VA and FHA loans, the wait can be as short as 2 years. With a Chapter 13 bankruptcy, if the bankruptcy has been dismissed, the wait is 4 years from the dismissal date. Or if the bankruptcy has been discharged, the wait is 4 years from the filing date. For government-backed loans, the wait time could be a little shorter. So in summary, when it comes to bankruptcy, when it comes to two of the biggest purchases people use their credit for, a car loan and a home loan, as you can see, it is easier to start over than most people think. Depending on the bankruptcy type, the wait is not that long. With Chapter 13, if you could get the trustee to sign off on a new loan, it is conceivable that you can get a new mortgage loan while in bankruptcy. Now, no one said that you would not be paying high interest rates if you manage to get this new credit while the bankruptcy is on your credit report. You would definitely be paying subprime rates for the privilege of new credit. But bankruptcy is not a financial death sentence where you can never get credit again. Plus, if we set your credit score aside just for a moment, there are many other ways to make these purchases that are not dependent on a good credit score or a credit score at all. But maybe I will save that discussion for a separate post. Another common question people ask about bankruptcies is, how long does it stay on your credit report? The answer is, it depends on the type of bankruptcy you file. Here are the general guidelines. If we are talking Chapter 7 bankruptcy, it stays on your report for 10 years after the filing date. If you did a Chapter 13 bankruptcy, it stays on your report for 7 years after the Chapter 13 filing date. Let's now talk about other type of judgments that could be affecting your credit report. Foreclosures. Foreclosures can drop your credit score anywhere from 100 to 160 points. Mortgage lenders will typically file a foreclosure after you have missed 3 to 4 consecutive monthly payments. Foreclosures stay on your credit report for 7 years. Let's discuss other civil judgments. What about civil judgments? Civil judgments occur when a creditor sues you for an unpaid debt and you lose. The court will enter a civil judgment against you. Now, the creditor can then use the judgment to garnish your wages or banking accounts. These type of civil judgments used to appear on credit reports, but that is no longer true. Although judgments are public record and anyone can see public records about you, civil judgments no longer appear on your credit report, nor do they impact your credit score. Tax liens. Tax liens. When you fail to pay taxes to the government, federal, state, a lien can be filed against your property. In the past, tax liens were usually included on credit reports. In fact, unpaid tax liens could formally stay on your credit report forever. That is no longer the case thanks to the National Consumer Assistance Plan that went into effect in 2017. No longer is there an effect of tax liens on your credit report. What is a good credit score? This is a common question when it comes to our credit reports. The answer is, it depends, of course, but the higher the better. The range for what is considered a good credit score can vary widely depending on the scoring model used, the purpose of the credit you are applying for, and what is determined to be a good score could vary by who the creditor or lender is that is checking your score. If you are just looking for some sort of rule of thumb, guidance, a range to get an idea about what is a good score and a bad score, I would say generally credit scores fall into these ranges. Below 579 is considered poor. Between 580 to 669 is generally considered fair. 670 to 739 is considered good. 740 to 799, that's considered very good. And if you're above 800, 800 or above, that's considered excellent. Again, look at this as a little rough guidance. There is no universal definition that is accepted by everyone. A good or excellent score is relative, but there are many criteria that goes into this, including what the purpose for the credit you are requesting is. What will it be used for? Who the lender is. Every lender has their own criteria. The scoring models used by the credit bureaus can also vary. So there is no single source of truth, just the guidance, this range of guidance that the credit bureaus generally give, as I outlined above. It is important to remember that everyone's overall credit profile is also different. Someone with a very high salary but a slightly lower score may receive more favorable credit terms than someone with a higher credit score but a lower salary. There is no one magic number that can guarantee approval of your credit application or guarantee better loan terms and interest rates. Higher credit scores mean you have demonstrated that you are responsible with managing credit and you are paying your bills on time. That gives lenders a comfort level when they view you as a borrower. If you are at the 670 level or above, you are generally viewed as an acceptable or a low risk borrower with some. If you are in the 580 to 669 range, you are generally seen as a subprime borrower. This simply means that you may find it more difficult to qualify for the best loan terms. In other words, you can find it difficult getting approved for loan programs. Lenders may require a co-borrower. And if you get approved for a loan or credit card, your interest rate is likely to be higher than others. Those with lower scores under 580 generally fall into the poor credit range. At this level, you would definitely find it more difficult to qualify for credit on your own. And if you do, your loan terms will likely be horrible. Different lenders have different criteria when it comes to granting credit, which may include information such as your income, are you a homeowner, and other factors. When these additional criteria are factored in, it can mean that the credit scores they accept may vary widely from person to person. Also, know that your credit score may differ between the three major credit bureaus, Equifax, Experian, and TransUnion. This is because the credit bureaus could be using different scoring models, and because not all creditors and lenders report to all three credit bureaus. So your scores are rarely the same across all three bureaus. That is nothing to be too concerned about. Good is good and bad is bad. If you have a good score at one, you are likely to have a good score at all three, even if there is a slight variance in your total score between the three bureaus. And when you notice a wide discrepancy between the three bureaus, that is a surefire sign that you likely have some sort of discrepancy in your report that you need to check out. Maybe there's some error or something's been omitted by mistake. Also note that many lenders do report your repayment activity to all three credit bureaus, but you may have an account with a lender that only reports your activity to one credit bureau, or maybe two of the credit bureaus. Or sometimes you think they're reporting it, but they're reporting it to none of the credit bureaus. I find this a lot. That is their right. No cause for alarm there. The point is, it is these sort of differences that can cause variances in your score between the three credit bureaus. Finally, when it comes to your overall score, know that there are many different scoring models available. And this can also make your score fluctuate or be different between the bureaus. Based on the scoring model used to compute your score may differ depending on the type of loan and the lender's preference for certain criteria. I believe FICO itself has more than 16 different versions of what we call the FICO score. At last count, I think they were at more than 16 different versions. Vantage Score has multiple versions of its scoring model. This is because lenders prefer different versions of the scoring models based on the type of loan you are applying for. Again, I would not worry about this or overthink this. Pay off your bills. Pay off your debt. Be responsible with your finances, and your score will go up. Higher scores are better than lower scores. This is all you need to be concerned about. Let's leave it at that. Credit repair. Let's talk about credit repair. I have good news. If you have a bad or low credit score, do not despair. It is rather easy to fix or improve your credit score. Although there are plenty of credit repair services that can help you repair your credit, it is something you can do easily yourself. Especially now, after going through this training, you are more knowledgeable about the topic. Once you begin the process of repairing your credit, you will begin seeing improvements in your score rather quickly. The self-cleansing aspect of your credit file. When it comes to improving your credit score, understand that there is a self-cleansing aspect to your credit file. One reason for this is because by law, certain activity on your credit file is required to drop off over time. More on that later. Another way your file self-cleanses itself is by you paying your debt obligations back. Your score will improve on its own. Just start paying your bills on time, every month, without exception. There is really nothing else you need to do. No special action you need to take. There are some activities you can do that will create a significant boost in your credit score, while others will result in incremental improvements to your score over time. For instance, payment history and credit utilization are at the top of the list when it comes to factors that have the greatest positive impact on your score. For example, let's say that you are currently overextended on your debt and you have a high credit utilization ratio, and maybe you have missed a few monthly payments and you have been late on a few other credit obligations. All of this will certainly have a negative impact on your credit score. However, to fix your credit and to begin to see improvements in your score, all you need to do is begin paying all your bills consistently on time every month and begin paying off the debt you owe. The scoring formulas are designed in such a way that your credit score will improve automatically over time. There is really no magic. Start paying consistently. Do not miss any more payments and make sure you are paying the minimum amount due on all of your bills by the due date. You must pay at least the minimum amount due every month consistently over time. Your payment history will improve and your credit utilization rate will also come down over time. These are two of the biggest factors that goes into your score. If you are consistent and you are paying your debts per your agreements, your score will gradually improve. It is that simple. Just pay your bills, at least the minimum amount due on time every month. In other words, just do what you are supposed to be doing. Do what you contracted to do when you signed that credit card application and when you signed those loan documents. Simply do what you have agreed to do anyway. When you start paying your bills consistently over time and paying down the amount of debt you owe, you will begin to see your score improve significantly as time goes on. Direct action. So you have a self-cleaning aspect of cleansing your credit or improving your credit, and then there are some direct actions you can take. So let's talk about direct actions. Aside from paying your bills regularly, sometimes you have to take some direct action and contact the credit agencies directly. This is typically required when you discover discrepancies or errors in your credit files. Now, each credit bureau has different instructions on how to correct errors and omissions in your credit file. So, if you ever need to contact them directly to clean up errors or omissions, go to their website and get the most up-to-date instructions on how to contest something in your credit file. Experian, TransUnion, and Equifax are the three you want to contact. Correcting a mistake in your Experian report will not necessarily fix it in your TransUnion report. If you do discover an error, and the error exists in all three reports at the three different credit bureaus, you will need to contact each credit bureau directly to correct the record. Let's jump back to the self-cleansing aspect of your credit report. Let's return back to this. The good thing is this: by law, certain activity on your credit file is required to drop off after a certain amount of time. The question is, how long does stuff stay on your report? Here are some rules of thumbs to remember. Most negative information generally stays on credit reports for 7 years. After 7 years, it will automatically drop off. A bankruptcy can stay on your credit report for 7 to 10 years, depending on the bankruptcy type. Again, after this time period has elapsed, the bankruptcy will drop from your report and your score will jump up significantly. Accounts that have been closed and you paid them as agreed, these can stay on your report for up to 10 years. Sometimes you may notice that information that should have dropped off is still showing on your credit report. This is one reason why you need to check your report routinely. When this happens, just contact the credit bureau directly and have them remove it from your report. It is that simple. How soon can you expect to see improvements in your credit? Remember that your lenders typically report your credit activity once a month. With that said, here are some guidelines as to how long it can take to see improvements in a damaged credit file. Let's look at what happens in the 1 to 3 month range. Paying down or paying off credit card balances will improve your score quickly because it will improve your credit utilization factor and it reduces the amount you owe. Once you pay off or substantially pay down a card or loan balance, it usually takes only a month or two after the creditor reports the activity for your scores to increase as a result. For errors and omissions, if you contact the credit bureaus to fix a mistake or to dispute fraudulent activity, this will usually be updated on your credit report within a few months. Once it is corrected, you will see an increase in your score at that time. That is the quick stuff. That is the 1 to 3 month range. Let's look at what you can expect over a 12 to 24 month range in regards to how soon you can expect to see improvement. The 12 to 24 month range is typically when you will see hard inquiries drop off. Hard inquiries, which result from applying for new credit cards and new loans, will remain on your credit report for up to 2 years. You cannot remove them before that time frame is up, but they will cease to impact your credit score after 12 months. That is the 12 to 24 month range. Let's look at the 18 to 24 month range. It usually takes 18 to 24 months to recover from late payments once you have started paying your bills consistently again. Recovering from late payments can vary. The more delinquencies you have, the longer it takes. Remember, a late payment will stay on your credit report for 7 years. However, as time goes on, the impact of those late payments you made, the impact on your score will recede over time. Those late payments will have less and less impact as time goes on. And again, after 7 years, they completely drop from your report. Payment history is one of the most significant factors in both the FICO and VantageScore models. So, anticipate a time period of up to 2 years of paying your bills consistently before the negative effects of prior late payments begins to completely go away. The 7 to 10 year period, what can you expect? Let's look at that. Foreclosures fall into the 7 to 10 year category. Foreclosures will stay on your report for 7 years. Once that time frame is over, it will be removed and will not factor into your scores. Bankruptcies. A Chapter 13 bankruptcy will be deleted from your credit report 7 years from the date you filed it. But a Chapter 7 bankruptcy will remain on your credit report for 10 years after the date you filed. Once the bankruptcy notation is lifted, whatever the type, it will not affect your scores anymore. Again, these are rules of thumb. That's the way I want you to look at them. These time periods, time frames are generally what you can expect in regards to how quickly you can expect derogatory remarks to drop off of your credit report, and in turn, how quickly you can expect your score to begin to improve. Here's some basic steps to help you clean up your score. Now, let's talk about direct actions you can take to clean up your score. If you have had credit problems in the past, here's a plan of action you can follow that will begin to repair your credit and raise your score immediately. We're going to talk about checking your credit, fixing any errors, paying your bills on time, paying off your balances, and not applying for new credit. So let's look at number 1, check your credit report. First, figure out where you stand. You do this by reviewing your credit file to see what is in there and where the problems lie. If you have high blood pressure, the first step in correcting high blood pressure is getting your blood pressure checked. You have to know the number. You have to know where you stand before you can devise a plan of action to fix the problem. So, review your credit reports from all 3 credit agencies, TransUnion, Experian, and Equifax. Review the reports to see what is causing your scores to drop. You can get your credit report for free once a year by going to annualcreditreport.com. Study the reports carefully, line by line, account by account. I would do this at least once a year in the beginning until you get your credit cleaned up. I would do it more frequently if you suspect fraud or ID theft. Identify what is really damaging your scores and concentrate your efforts there. Is your credit utilization high? Have you been paying your bills late and it is dragging down your scores? Is there an error on your report? Erroneous information? Your report will tell you what is bringing your score down and what needs to be fixed. As I stated, you can get your credit report for free once a year at annualcreditreport.com. Check the link in the description. This site is sanctioned by the 3 major credit bureaus, and it is the only one authorized by federal law to issue you a truly free credit report. You may find that more and more of your financial service institutions that you do business with, like your banks and your credit card companies, will provide you a free copy of your credit report and your credit score as a service for being a customer, free of charge. Beware, now, some websites may claim to offer free reports as well, but the Federal Trade Commission, the FTC, warns that these offers can often be deceptive. With that said, there are some free apps out there as well that have proven to be reliable and trustworthy that many people use. These apps can give you a good idea of where your credit report stands. They offer tips on how to improve your score. They can trigger alerts when your score changes. 2 of the more popular free credit monitoring apps that comes to mind are Credit Karma and Credit Sesame. I use Credit Karma often myself just to get a checkup on where my score stands from time to time and to see what has changed in my credit file. I use it as more of an ID theft protection service as a way to be notified and to check for untoward activity in my credit files. Second way, number 2, on how to fix and clean up your credit report would be to fix any errors or incorrect information in your report. Now, after you check your credit report, you've received your credit report, you requested it, you received it, you've checked it. If you find any errors, you need to fix them. Dispute any fraud or any mistakes on your report by contacting the credit reporting agency and your lender. If you just go directly to the website of the credit bureau that is reporting the mistakes, Experian, TransUnion, or Equifax, their website will instruct you on exactly what to do and what form to fill out to correct any errors. By law, the bureaus have a certain amount of time to get any errors corrected, or they must, by law, remove it from your report. Step number 3 on how to fix your credit report. Pay all bills on time going forward. If you have not been doing so already, start paying your bills on time. Your payment history or making payments on time is one of the biggest factors contributing to your credit score. If you have not been making your payments on time, this is something you must fix, and you must fix it immediately. This one act comprises around 35% of your overall score. If you have missed payments, do not worry at this point. Just get current and stay current. Once you get current and start paying on time, you will find that the impact of those past credit problems recedes over time. They'll have less and less of an impact. If you are having trouble making payments or you are behind on payments, contact your creditors or seek the service of a credit counselor. You will find that many creditors will work with you if you reach out to them about your financial difficulties. For unsecured debts like credit cards, you will find that those are some of the easiest debts to negotiate a payment plan on or a settlement that you can afford. Step 4 on cleaning up your credit. Pay down credit card balances. Once you start paying your bills consistently every month, your balances will obviously begin to come down. But if you are able, pay extra on your debt so that you can reduce the amount of debt you owe quicker. This will improve your credit utilization. Your credit utilization, or the balance of your debt compared to your available credit, this ratio contributes 30% to a FICO scores calculation, approximately 30%. The faster you can pay down and get rid of your credit card balances, the bigger improvements you will see in your score. When it comes to credit cards and other revolving debt, either pay them off or keep balances low. My advice, I say, pay those credit cards off in full every month. But at a minimum, try to keep your credit utilization below 30%, the professionals say. I say try to keep it below 10%. 0 to 10% is my comfort level on credit utilization. Just know that a high level of outstanding debt will negatively affect a credit score. If your goal is to raise your credit score, I would not close unused credit cards or other revolving lines of credit like HELOCs either. Leave the accounts open even after you pay them off. Stop using it, but leave it open. Remember, closing the card account could increase your utilization ratio and shorten the length of your credit history. Again, if your objective is a high FICO score, closing the accounts could actually hurt your FICO score. And the final step I would give you, step number 5, to clean up your credit. Do not apply for new credit. If your credit is in disrepair, I would highly recommend that you do not apply for or open new lines of credit. Just fix what you have and pay off your debt. Now, I want to talk about the difference between a debt verification letter versus a debt validation letter. Sometimes you need to write a letter to a debt collection agency, and these letters come in one of these two varieties. Either it's a verification letter or a validation letter. Now, If you find yourself in a situation that you need to write a letter to a debt collection agency because you are disputing a debt they claim you owe, or there is a dispute in the amount you owe, you should know this difference between the two letters, debt verification versus debt validation. What is debt verification? Debt verification is the process whereby the collection agency must confirm the debt is valid and it is not outside the statute of limitations for collecting the debt. What does it mean to validate a debt versus verify a debt? Well, debt validation, on the other hand, is the process of receiving a written confirmation from a collection agency that the debt is really your responsibility and the outstanding balance is accurate. The collection agency will also need to prove that they have been assigned to collect the debt. Those two definitions might sound a little similar. Let's talk about the differences in these two. There are many example letters, by the way, on the internet of these different types of letters that will show you what you should include in each one and how to use them. I simply point out here that there is a distinction between these two types of communications, and the letters should include different content based on what your intention is. We are getting a little bit into the weeds here, and this is probably more than most of you need to know. Just know this. Generally, debt verification is not as powerful as debt validation. A debt verification letter cannot stop debt collection. Verification just requires the debt collector to confirm the contact details they have for you on file, the debtor, that they have for you, the debtor. They just need to confirm it's accurate. Whereas a debt validation request, on the other hand, those letters can actually stop collection activities altogether if the debt collector cannot validate the debt is yours, and with documents like the original contracts, bills, or statements. They must produce that to validate the debt is yours. And you would be amazed at how often the debt collector cannot produce this information. In closing, now that you have this basic understanding on credit repair, you can begin to fix your own credit, clean up your file, and improve your credit score on your own. However, there are many services out there who can help you do this, who can do this for you, for a fee, of course, if this is something you do not want to do yourself. Protect your identity. ID theft. What is it? Identity theft is when someone steals your personal information and assumes your identity. Information like your name, social security number, bank account, and credit card numbers, and other personally identifiable information. People do this for nefarious reasons, obviously, so they can commit financial crimes using your identity, like making charges against your credit cards, or opening new credit cards in your name, or taking out loans in your name, or raiding your checking or savings account. To protect your credit report and identity, the best thing you can do is be vigilant by doing the following. Freeze your credit. Freeze your credit with all three major credit bureaus, Equifax, Experian, and TransUnion. What this will do is restrict access to your credit file so that no new credit inquiries can be made on your file without you explicitly removing that freeze. This will make it nearly impossible for someone to open new accounts in your name without your knowledge. Freezing your credit file is free. The credit bureaus will try to upsell you to their credit lock service for a fee, of course. You do not need that credit lock service. Freezing your file will provide the best protection against identity theft. Check your credit report regularly. You should check your credit report regularly and look for untoward activity, things that don't belong, accounts you do not recognize, double charges, etc. Just look for something odd. You can check your credit report for free at annualcreditreport.com. More and more finance service companies will give you your score for free as well, and some will give you a report. I like annualcreditreport.com because they are the official arbiter. Annualcreditreport.com is the only official site explicitly directed by federal law to provide your credit reports for free. You should also use alerts. Definitely in today's digital world, you should be taking advantage of alerts on all of your financial accounts. Most financial institutions will allow you to set up text or email alerts when transactions are made on your accounts. So please, I highly recommend you set these alerts up on your accounts. They come in various shapes and forms depending on the financial institution. You can usually set thresholds for, say, every time there is a transaction over the amount of $100, you can set your account up to notify you by text or email. I set my accounts up so that I am notified if even one penny moves on any of my accounts. I highly encourage this. This way, if someone does get access to one of your credit cards, for example, you will know immediately if someone is posting charges against your card without your authorization. Another thing you can do is protect your social security number, your SSN, and other personally identifiable information and account numbers. Your social security number is the master key to your personal data. Guard it as best you can. When you are asked for your number, ask why it is needed and how it will be protected. Do not carry your card with you, your social security card. Securely store or shred paperwork containing your social security number once you're done with it. They said ounce of prevention is worth a ton of cure. Here's a preventive step you can do. The best way to deal with ID theft is to prevent it. I highly encourage you to use the tactics I just outlined to help you avoid ID theft in the first place. Treatment. If you discover or suspect someone has stolen your identity, do the following to deal with this situation. Notify the credit bureaus immediately and put fraud alerts on your account. If you have not done so, freeze your accounts. File a report with the FTC, Federal Trade Commission. Depending on how bad it is and how far the thieves have made it, you may even need to file a police report and contact your insurance agency. Now, there are credit monitoring services out there. Credit monitoring services can help you in the case of a credit breach. Not only do they monitor your credit activity for you and help flag any suspicious activity, but if your identity is stolen and damage is done to your credit profile as a result, they would do most of the legwork for you by taking the lead and notifying all the right parties and helping you repair the damage. Credit monitoring services are quite common and ubiquitous these days. Many banks, credit cards, and insurance companies will offer the service for a nominal fee. I notice that many employers are now beginning to offer the service as a benefit to their employees. You probably could get this without paying any money for it. But again, if you freeze your credit, set alerts on your accounts, check your credit reports regularly, like once a year or more frequently if something is suspected that's wrong, and use common sense when handling your personally identifiable information, like your social security number, bank account, and credit card numbers, these tactics will greatly minimize the threat of identity theft in your financial life. I'll leave you with some takeaways. One, let's just boil this down to its essence. All you need to do is pay your bills on time. You must pay at least the minimum amount every month on time, and you're going to see your credit score rise over time rather quickly. Pay off your credit card balances every month. This affects utilization rate. Utilization rate is so important. Once you get over 30% in your utilization rate, you are really starting to negatively impact your score. Try to keep it below 30%. I would say no more than 10. Quite frankly, I would say keep it 0. And what that means is pay off your credit cards every month. Pay off the balances of any long-term debt. That should be your goal. If you can't pay it off right away, make that a goal to start paying it down by paying extra every month. This will improve your utilization rate, and that will really give you a positive jolt to your score. Check your credit report once a year. Look for errors and omission. You're checking your credit report is you checking your blood pressure, your cholesterol level. You don't know if you need help and how you can get healthier unless you know exactly what the picture is, what the numbers say. So get in the habit of checking that at least once a year. And if you are have collectors coming after you and you're setting up payment arrangements and trying to pay off debt, I would never give direct access to my bank or checking account to repay a debt. So be careful with that. I advise that you do not do that. And finally, here's some good resources. These first few, particularly if you owe money and you have bad debts and collectors are coming after you, I would read up on some of these acts: Fair Credit Reporting Act, Consumer Credit Protection Act, Fair Debt Collection Practices. You should know your rights as a consumer. Get educated, know your rights, know what they can and can't do and what you can and cannot do and what your options are. Annualcreditreport.com. That's where you go to get your free credit report. You can get a report once a year, so you can go there to get that report. MyFICO.com. They've been around forever. Tons of useful information. Again, if you want to get yourself educated, I would definitely hit that site and their content. Equifax, TransUnion, and Experian, the three major credit bureaus, they actually have a lot of great, useful consumer information there that will increase your IQ on this. So the list is long. There's a ton of resources out there. These are just some of the more popular ones. And the whole point of this training is for you to educate yourself on this topic. So use these resources and more to get yourself educated. The main thing I want you to get about your score, how to improve your score, is it is self-cleansing. Start doing the right things. Get current on your bills, pay them regularly, keep your overall debt amount low, pay your debt down, pay it off. The score is self-cleansing. There's nothing you need to do but the right things. Pay your bills according to your agreements. That's all. And then you're going to see your credit score improve naturally. It's designed to do that. Finally, I'm going to reiterate, there's a lot of credit services out there. A lot of people offer those services to help you clean up your score and do that sort of thing. And quite honestly, I'm not one of those people, but I don't, some people just don't want to deal with this. They like to hand off these sort of services to other people. Just do your research on those people. If that works for you, make sure you just get the right person, do your research. But if you went through this entire training, you can see how you can very easily do this yourself. And 80% of doing this yourself is just doing the right thing, paying your bills on time every month, and you'll get the result you're looking for. Okay, I hope this was helpful. Good luck to you.